Our last class, we looked at the concept of financial analysis. Financial analysis is the evaluation of a company financial statement. Financial analysis is the evaluation of a company financial statement with a view to assessing the company's past performance and to project the company's future financial prospects. The purpose of financial analysis is to assess or to evaluate a company's past performance and to predict the company's future financial prospects. Please, can you mute? When you are getting to this class, please check your speaker. Please mute. Now, to carry out financial analysis, you can use vertical analysis of the financial statement. You can do horizontal analysis of the financial statement. Our horizontal analysis is the trend analysis, or you can do ratio analysis, or a combination of all these three can be done in order to carry out financial analysis. We explain the different ratios: profitability ratio, liquidity ratios, financial risk ratio, and investors ratio. We try to explain the DuPont model. The DuPont model is a model that explains how two or more ratios can be used to explain a particular ratio. The DuPont identity was developed to explain the value or change in the value of return on equity. The DuPont identity was originally used to explain return on equity or changes in return on equity. With DuPont identity, you can use three ratios to explain return on equity. We can use three ratios to explain return on equity. These ratios are profit margin, asset turnover ratio, and financial multiplier, financial risk multiplier. Our operating profits is the net profit divided by revenue. Our asset turnover ratio is the revenue divided by total assets. And our financial risk multiplier is the total assets divided by shareholders' funds. These three ratios can be used to explain return on equity. I want to assume that why this model is used to explain return on equity is because equity holders are the owners of the business. And the primary objective of a business is to maximize the wealth of the owners. So this model is trying to explain how to maximize wealth of the owner. To maximize the wealth of the owners, you must look at your profit margin. Your profit margin is the measure of operating efficiency or operational efficiency. Our profit margin is the measure of operational efficiency. Our asset turnover ratio is the measure of asset utilization efficiency. Then our financial risk multiplier is the extent to which the company has leveraged debt. The extent to which the company has taken advantage of debt. We explained this. So far, we have solved 2 questions on this topic. We have treated question number 6. We have treated question number 1. Let us look at question number 2. On this platform, I hope we can finish this question within the record time. Question number 2. Of course, the material we are using is our financial statement material shared last week. Please refer to this material. Let us look at question number 2. All right, question 2. Adeyinka PSC. Okay, any question, please? All right, 20 students online. Is it fine? Adeyinka PSC operates in the hospitality and leisure industry. The board of directors met recently to discuss a number of financial proposals. Proposal 1, to increase the company's level of debt by borrowing. Please, can we mute? So many speakers on here. Sarah, Ibikunle, Yusuf. Please, can we mute this speaker? Ibikunle. All right, proposal 1, to increase the company's level of debt by borrowing a further 100 million and use the funds raised to buy back its shares. So the company is looking at borrowing 100 million. When we get the cash, the company wants to repurchase its shares. Proposal 2, to increase the company's level of debt by borrowing a further 100 million and use these funds to invest in additional non-current assets in the form of expansion in available rooms in one of their hotels. So proposal 2, the company wants to borrow 100 million. And the money realized from this borrowing will be used for investment, expansion of the company's hotel. Proposal 3. To sell excess non-current assets in another hotel. The book value of this asset is 100 million. They will be sold for 135 million. This will enable the company to focus on the other high-performing hotel units. These other hotel units will require no additional investment in non-current assets. All the funds raised from the sale of the non-current assets will be used to reduce the company's debt. So proposal 3 is a company will sell, will dispose its non-current assets. The book value of the non-current asset is 100 million. They will be sold for 135 million. Money generated from these sales, all the funds will be used to reduce the company's debt. We are going to repay our debt. Adeyinka's financial information. We have the non-current assets. We have the current assets, total assets, equity and liabilities. We have share capital, retained earnings, total equity, non-current liability 6%, amount 700 million, current liability 185 million, total liability is given. Then we have total liability and capital. Adeyinka PLC forecast profit after tax for the coming year in the absence of the above proposal. Without the proposal, the company profit after tax is 130 million. The current share price is 3.20 naira. The non-current liabilities consist solely of a 6% medium-term loan, redeemable within 7 years. Please underline this word. Please, this word, if it is possible, asterisk these words, this sentence. The term of the loan contract stipulates that any increase in borrowing will result in increase in the coupon payable of 25% basis points on the total amount borrowed. Let us explain that. The condition attached to the loan is that anytime the company borrows more money, the interest payable will increase. The interest payable is the coupon. The interest payable will increase by 25 basis points on the total amount borrowed. Total amount borrowed is the existing borrowing and the new borrowing. Interest rate will increase. Thank you. Why a reduction in borrowing will lower the coupon payable by 15 basis points, meaning that anytime the company repays its debt, the interest will be reduced by 15 basis points. Okay. Adeyinka effective tax rate is 20%. The company's estimated after-tax rate of return on investment is expected to be 15% on any new investment. We need to explain this also. Anytime the company make new investments, company will get 15% return on the investment after tax. It is expected that any reduction in investment would suffer the same rate of return, meaning that if the company should divest. Divestment means if you sell your investment, then your return will reduce by 15%. Now, requirements. Requirements A. I'm trying to create space in Ijari. Estimates the impact of each of the three proposals on the forecast statement of financial position, the earnings per share, and the financial gearing. In brackets, financial gearing is calculated as total debt minus total assets. That question has been given to us now. Assuming you are faced with this question, you want to use financial statements to know the impact of three proposals. So, assuming you are faced with this, how do you approach this? Assuming you are faced with this transaction, how will you go about it? You are going to treat each proposal independently. You are going to take proposal 1. The impact of proposal 1 on the financial statements, earnings per share, and financial gearing. When you are done with proposal 1, you move to proposal 2. Impact of proposal 2 on the forecast financial statements, the earnings per share, and the financial gearing. When you are done, move to proposal 2. You are going to look at the impact of proposal 2 on the forecast financial statements, the earnings per share, and the financial gearing. You can now comment on your results. Let us go to the whiteboard. First, to make it faster, we have created the board for us. Now, this is what you are giving currently, current forecast. This is the foreign forecast. I only pick this foreign forecast as we are given in the question. The current forecast. Look at it. If you look at the statement, please look at the question yourself. Non-current assets is given to us to be 1,400 million. It's million, not 30. 1,400 million is in million. In million, this is proposal 1, in million, proposal 1. Proposal 2, in million. Proposal 3, not 6, proposal 3. So I try to prepare this ahead to save time in the class. Okay? If you look at the question, you have non-current asset 1,410, current asset 330, total asset 1,740. Just 1 minute. Let's continue. After total asset, we have current liability, 185 million. Non-current liability, 700. Total liability, 885 million. Next, our share capital as given to us in the statement, 240 million. Our retained earnings, 615 million. Total equity, 855 million. Then we have total liability and capital. That is your total liability plus total share capital, total equity capital. Please add 885 plus 855. That will give you 1,740. This was given to us in the question. The profit after tax is given to us as 130 million. We try to bring what we are giving. Now look at number of ordinary shares. How do we get this? Nominal value per share is 40 kobo. Total nominal value is 240 million. Please divide. 240 million divided by 40 kobo. Number of ordinary shares. And please get your calculator near you. If you check that, you are going to get 600 million shares. Now, earnings per shares. Profit after tax divided by number of ordinary shares. 130 million divided by 600 million. What do you have, please? That will give you, multiply by 100. That will give us 21.6 kobo. Then financial gearing. The examiner says our financial gearing is total debt over total assets. Look at the total debt. Our total debt is our total liability. 885 million divided by total assets. Our total asset is 1,740. Please work this out. Multiply by 100. You are going to get 50.86%. This is the information given to us in the question. This information was given to us in the forecast financial statement. The question now says, look at proposal 1. What is the impact of proposal 1 on this forecast financial statement, on the earnings per share, and on the financial gearing? When you are done with that, move to proposal 2, proposal 3. We now ask ourselves, what is proposal 1? Proposal 1 says the company will borrow, the company will increase the level of debt. Look at proposal. Let's go to the question set. Proposal 1. To increase the company's level of debt by borrowing further 100 million and use the funds raised to buy back the company shares. Let us go and look at the impact of proposal 1. Okay. Okay. I've opened a new board for proposal 1. Please confirm you can see my whiteboard. Hello?
Yes, we can, sir.
Yeah. Proposal 1. Increase debt by 100 million. To increase debt by 100 million. And use the funds to buy back shares. What is the impact of proposal 1 now? The first question, let's look at increase in debt. If there's increase in debt, what will happen to your interest expense?
It will increase.
Good. Our interest expense will increase. If your interest expense increases, what happens to your profits?
Reduces.
Our profit will reduce. If your profit reduces, what happens to your tax?
Also reduces.
That will also reduce. That's great. Now, if you pay your interest by cash, what happens to your cash?
It reduces credit.
Thank you. That means we are going to look at all the items this increase in debt we have faced. We come here. Interest. The interest rates. The interest rate is before now. The interest rates on debt. Well, this is not the interest rate is 6% on debt, existing debt. Now look at it. Examiner says The term of the loan contract stipulates that any increase in borrowing will result in increase in the coupon payable of 25 basis points on the total amount borrowed. That means by increasing our debt, we have increased our borrowing. The interest rate payable will increase by 25 basis points. We now move back. That means the interest rate now is, before we have 6% plus 25 basis points. I will now convert basis point to percentage. That means my new interest rates is equal to 6% plus, to convert basis points to percentage, you are going to multiply, you are going to divide by 100. 25 divided by 100, that will give me 0.25%. That means the new interest rate now is 6.25%. I will now calculate interest on the new debt. Interest on new debt. The new million, that becomes 100 million. Sorry, please. $100 million multiplied by 6.25%. That will give us 6.25 million. That is the interest on the new debts. Now, the condition says there will be 25% on the total debt. The total debt is 25 basis points on the total debt. The total debt is the existing debt and the new debt. We have introduced 25 basis points to the new debt. We now need to introduce 25 basis points to the existing debt. I'll now come here. Extra interest on existing debt. Our existing debt is 700 million. You can go back to the question. Look at it. Non-current liability, 6%, 700 million. The question says, the non-current liability consists solely of a 6% medium-term loan. That means our existing debt is 700 million. On this existing debt, we have calculated 6% before. How do we know? Thank you. How do we know that we have calculated 6% before? Now, we are told that the profit after tax of the company is 130 million. For you to have profit after tax, that means you have deducted interest. You have deducted tax. In the absence of the above proposal, the profit after tax is expected to be 130 million. That means Interest has been calculated at 6% before. Tax has been computed. But because we are now increasing our borrowing, condition says anytime you increase your borrowing, you are going to pay extra interest, 25%, 25 basis points. We now need to compute the additional interest on the existing debt. That will be computed as 700 million multiplied by 25 basis points in percentage, 0.25%. Please compute 0.25% of 700 million. What do you have, please? Please, let's make this. You should have
175.
Yes, no, that's it. Thank God. You should have 1.75.
700 million times 0.25%. Okay.
Percentage. You are going to have 1.75 million.
Yes.
That's why it's good to compute. That means our total interest now. Interest on new debt and extra interest on existing debt. Total interest is equal to total interest cost. Please sum up. This should give us 8.0 million. Is that correct, please? I think so, yeah.
Yes, it is.
Yeah, this is total interest. If you pay this interest, you are going to enjoy tax relief. Is that not, please? Accountants.
It's correct, sir.
If you pay interest, your interest will entitle you to tax relief on interest. Now come here. You can expand this. I can now come here. Tax relief. What is the tax rate, please? What is the tax rate in this question?
20%.
Somebody should confirm. Yeah, thank you. 20%. Please compute 20% of 8 million. I think that should give us 1.6. Now less this. That's the tax relief. They are going to get 6.4 million. This is called interest paid. Interest paid net of tax. That means by borrowing further 100 million, our we increase by 8 million. We are going to enjoy tax relief. The tax relief will reduce the interest cost we paid. Then we are going to now pay interest paid net of tax, 6.4. Now, what will this affect in our financial statement? What are the components of financial statements that will be affected by interest paid. What are the components of your financial statement that will be affected by interest paid? Look at it, please. I'll move to working 2 here. You have profit after tax. My profit after tax will be affected by interest paid. We have retained earnings. My retained earnings will be affected by interest paid. Retained earnings. You have current assets. Our current asset will be affected because if you pay interest, your cash will reduce. Your cash is part of your current assets. I will now come here. The balance. Balance before. This is 130 million. Let's go to these statements. Our profit after tax is 130 million. Let's write this very so it doesn't. For the proposal, our profit after tax was 130 million. Our retained earnings before proposal 1 was 615 million. Our current asset before proposal 1 was given to us to be 330. We move to working 2 to page 2. This is 615. This is 330. Interest paid. By paying interest, net of tax, this will reduce our profits. 6.4. Of course, our profit is part of retained earnings. The interest will also reduce our retained earnings. Also, our current assets, our cash will be reduced by 6.4. Okay? We have treated the impact of interest paid. Any question, please?
Where did you get 6.5 under interest paid on retained
It's
earnings?
an error. Just correct me. Supposed to be 6.4. So if you find yourself in exam, I explained to us that when it comes to financial statement analysis, it's going to tell us if you understand accounting principles or not. As soon as I observe that my interest will increase, you are not going to ask yourself, this increase in interest, what are the items this increase in interest will affect? Automatically, it will reduce my profit. You minus it from your profit. It's going to reduce my retained earnings because my retained earnings is my retained profits. Interest paid will reduce my cash. My cash is part of my current assets. Any question to this, please? All right. We are still on We are still on, what's it called? We are still on the first one. We continue. Continue like that. I'm trying to expand this. I'm trying to create more space. Knowledge is power. I'm trying to create more space. Now, if you borrow 100 million, what are we doing with the money?
Buying back shares.
Thank you. Buying back shares. You now ask yourself, please create a space here. Okay, anyway, if you're not even copying anyway, I'll create a space here because I'll still come back to this working 2. I'll go to working 3. To buy back company shares. Company's shares with 100 million. Now ask yourself, with this 100 million, how many shares can we buy back? That will now take us to the question of what is the current market price per share? With 100 million, how many shares can we buy back? That will now take us to what is the current share price? Look at it, please. The current share price is 3 naira 20 kobo per share. Okay. And I'll come in. Current share price is equal to 3 naira 20 kobo per share. So with 100 million, how many shares can we repurchase?
31.25.
We have to work it out. And I'll come here. Number of shares repurchased is equal to 100 million. I'll write it in full. 100 million divided by 3.20. How many shares can we buy back? Now you can give me the figure now. 31 million 250,000 shares. We can buy back 31 million 250,000 shares. Now, if you are buying back, the same way, if you issue a share at premium, when you issue shares at premium, you are going to separate the nominal value from the premium amount. Is that not, please? Accountants.
Yes, sir.
Yes, sir.
If you issue a share for premium, you are going to separate the nominal value from the premium amount. The same way, if you are buying back shares at a premium, because the nominal value per share is 40 kobo, if you look at the statement, and we are buying back these shares at 3 naira 20 kobo, that means we are buying back these shares at a premium. We are going to separate the nominal value from the premium amount. Let's go and separate. Nominal value is 40 kobo.
How did you get 40 kobo?
Look at your question. Who is speaking, sir?
Okay.
Who is speaking? Let me put a name to it. Look at it. Share capital in bracket 40 kobo per share. Can you see it now? Can you see it now?
Yes.
So you can go back now. We now separate it. Nominal value, nominal value is equal to 40 kobo is 0.4 now. 0.4 kobo, 0.4. That's nominal value per share. Multiplied by number of share repurchase, 31,250,000. Please multiply. That should give us 12.5 million. Please reconfirm. Why the premium amounts? The premium amounts. Out of 320, 0.4 is nominal value. What is the premium? Who will I know that class? Where's Falandes? Okay, where's Chukudi? It's not online.
Yes, I'm here, sir.
I don't know many names. Where's Christy? I only know few names in that class.
2.82.
Okay, please, what's your name? Let me put a name to it. $31 multiplied by 250. 2.8 multiplied by 31, 200. That will give us how much, please? 87.5. You see it now? That will give us the total 100 million repurchase. Now, please note, nominal value will be nominal notes, MB. Nominal value will be deducted from the share capital accounts, from share capital. The premium will be taken from your reserves. The premium amounts will be deducted from reserve account. The reserve account we have now is our retained earnings. From the retained earnings. Retained earnings. We can now go and treat this now. We can treat this now. Look at it, please. I will come here. The premium amounts to be deducted from retained earnings, 87.5. 5. Nothing is here, nothing is here. You can now get your balance, please. For working 2, please get your balance. 130 minus 6.4. What do you have?
123.6.
123.6. Retained earnings 615 minus 6.4 minus 87.5. What do you have, please? That should give
521.1.
Thank you. Then current assets 330 minus 6.4. That should give us
323.6.
323.6.
323.6.
323.6.
We can now go back to our, please note all these figures for adjustments. All these figures. We can go back to the statement now. For proposal 1, we are going to borrow more money. We are going to increase our debt. And we are going to repurchase shares. Will this affect our non-current assets? Will this proposal affect our non-current assets?
Yes.
Yes.
No. How will this affect your non-current assets? Your non-current asset is not affected. You are borrowing more money. You are repaying, you are repurchasing shares. How does it affect your non-current assets?
Sorry, error of mine. This current assets.
Our current asset value now has changed. From working, current asset is now 323.6. I'll come back here. Come back here. This is 323.6. Total asset, please sum. What do you have? Total assets 1,733.6. Next, current liabilities. By borrowing 100 million, is our current liability affected? Is our current liability affected? Answer is no now. We borrow 100 million. It's not affecting our current liability. Non-current liability. We borrow more money. Our borrowing before was 700. We now borrow 100 million. What do we have here?
We now have 800 million.
800 million. Total liability. Current liability plus non-current liability.
We have 985.
85. I'll close this. Number of shares. Definitely number of shares. Okay, look at it. Share capital. Look at that note. Look at this note now. Nominal value will be deducted from share capital account. 12.5 million. Deduct this from 240 million. What do you have? 240 million minus 12.5 million. You are repurchasing your shares. Your share capital will reduce.
227.5.
Thank you. 227.5. By repurchasing the shares, our share capital will reduce by the nominal value of shares repurchased. Our retained earnings will be affected. Retained earnings figure is now 521.1. I'll come here. 521.1. Total equity, please sum. Share capital plus retained earnings. What do you have?
748.6.
7.6.
748.6. Next. What's our profit after tax now with the adjustment? 123.6.
Yeah.
Oh, sorry. Total.
We need to total liability and the capital.
Yeah, we need to add these two. Total liability 985 plus total capital, shareholders capital 748.6. What do you have? 1733.
36.6.
Your account must balance. Look at it. Our account balances. Total assets 1.733.6. Total liability plus total capital 1733.6. Our profit after tax now, after adjustment, 123.6. Number of ordinary shares. Definitely this will reduce, Nabi. We are repurchasing 31,050,000 shares. So 600 million minus 31.25. What do you have? Number of shares becomes 568.75. Is that clear, please?
Yes, sir.
Please, let's ask question if it's not
Yes,
clear.
sir.
Sir,
Because
I have a question.
please speak out.
The current liability, I might be wrong, but I was thinking since the tax, I think the question is payable during that year. Are we not supposed to increase it by the tax?
Current liability.
Yes.
So if you pay, once you have paid the tax, are you still owing government?
Okay, it's tax paid. Okay, that's fine.
Is that clear, sir?
Yes, sir.
We have paid the tax now. And that's why we deducted it from our cash.
Noted,
If
sir.
you are not deducting from your cash, that means you want to treat it as if you are still owing. Is that clear, sir?
Yes, it's understood. Thank you, sir.
Welcome. So calculate earnings per share now. New earnings per share. Profit after tax 123.6 divided by number of ordinary shares 568.75. What is the profit after tax?
Twenty-one
21.73.
point seven. 21.7.
21.7
7.
kobo. Once you multiply by 100, you are treating in kobo. Is that clear, sir?
Yes, sir.
What is so? If you look at the question, because it's one of the questions that I feel that I can might still retext, might be returned. It was tested in 2020, and if you go to that 2020 November diet, examiner comment post like student cannot even do this question. So when we look at question, it's okay. It's not impossible that one diet, the examiner will say, let me return this question back to them. Like what happened last diet? All the questions tested from PM, all the 7 questions were past ICANN questions. And you know, it's to your advantage if you have like 1 or 2 questions that you already know what to do. So the question says, what is the impact of each of the proposal on the financial position? We have done that. On the earnings per share, you observe that with proposal 1, earnings per share, what is the impact on financial gearing? Your financial gearing is total liability divided by total asset. Now, please check. Total liability is 985 million. Total asset, 1,733.6 million. What is multiplied by 100? What is the financial gearing now?
56.8.
56.8%. Once you multiply by 100 for financial gearing, you are looking at a percentage. You observe that with proposal 1, earnings per share will increase slightly. And financial risk will also increase. You are done with proposal 1 now. You now move to proposal 2. Is that clear, please?
Yes, sir.
Yes, sir.
We move to proposal 2. What is proposal 2? Can somebody read? If you have the material, can we read? I'm sure you have the material. Okay, let's look at it. Look at proposal 2. To increase the company's level of debt by borrowing a further 100 million and use the funds to invest in additional non-current assets in the form of expansion in available hotel rooms. That means for proposal 2, we are still going to borrow 100 million. Our interest will still increase. Our profit will fall. Our tax expense will fall. When we now get the money, we are not repurchasing shares now. We are going to use the money to invest in additional non-current assets. That means our non-current assets will now increase. If you now make additional investment, what is the impact of this? We move to proposal 2 fast, because I still have another class. Although we started this class late, I still have PM class. It was, secretary is not aware that we are having online class. He was even coming to VISF. She was coming to VISF. So proposal 2 now. Proposal 2. Increase debt by 100 million. Then use the funds. Use the funds to invest in additional non-current
Sir, we can't see your board. We are only seeing the question.
Thank God, though. Apology. I thought I have shared the board. Thank God. That's why, thank God you are speaking now to Iwe. All right. You should be able to see it now.
Yes, sir.
And you,
Yes, yes.
and you,
Yeah.
in additional, oh, this thing should come up. Additional non-current assets. This is proposal 2. So what is the impact of proposal 2 on the forecast financial statements, on the earnings per share, and on the financial gearing? Of course, increase in debt. Increase in debt. With increase in debt, we are still going to have by 100 million. We are still going to have interest paid net of tax. That working we did is still valid here. Interest paid net of tax. That computation we made previously is still valid here. That is 6.4 million. Very valid. Now, what are we using the 100 million for? We are going to use the 100 million for additional investment.
Investment in non-current assets.
Thank you. Now let's look at the rule on investment. Look at the last paragraph, please. The company's estimated after-tax rate of return on new investments is expected to be 15% on any new investment. By investing more in additional non-current assets, that means we are making new investment of 100 million. And we expect that we are going to get a return after tax. That return is 15% of our investment. Please, let's go and get the return. I'll now come here. After tax return on investment. After tax return on investment. On investments is equal to 15%. Let's work it here. 15% of 100 million. We invested 100 million. That will give us how much, please? That will give me 15 million. Now we are not going to ask ourselves, these two variables, these two items, interest paid net of tax, return on investment after tax. What are the components of our financial statements that this variable will affect? Hello? What are the components of the financial statements that will be affected by these two variables? Clearly.
It will affect the profit after tax.
Great.
It will affect non-current assets.
Non-current asset, that's great.
Also current assets.
That's great. It will affect our retained earnings.
Retain earning too. Yes, retain earning.
Because if you pay your tax, so if you pay interest net of tax, your cash will reduce.
Yes.
If you make more profits, more returns, then your cash should increase. So we can now go to these effects. Some of you just like physical class. Online class is also good. It's just that it's stressful. Lecturer, we have to do a lot. Online class is good. There's my come here. Oh, where is this thing hiding now? No, I'll see expand it. Yeah. Trying to expand this one. I'm trying to expand this space. Okay, let's continue. I'll now come here. I'm going to look at the profit after tax, my retained earnings. Okay, my retained earnings. My current assets. My non-current asset will also be affected. Let's also put it here. Although we can do that one straight. My non-current assets, non-current assets. Again, my non-current liability. My non-current liability, non-current liability. But you can actually do this straight in your, you can do this adjustment straight. The balance we have before this proposal, this is 130 million. This is 615 million. This is 330 million. This is given to us as 1410. And we have this to be 700 million. Our interest page. This will affect income statement. 6.4. This will affect retained earnings. Minus 6.4. This will affect my current assets. Minus 6.4. This will not affect it not affect here, not affect here. Return. 15 million will affect my profits, positive. Will affect my retained earnings. Will affect my current assets. No impact here, no impact here. Increase in debt. Increase in debt, increase in debt. Will not affect income statements, current assets. It don't affect my non-current asset, but it will increase my non-current liability. Investment No effect here, no effect here, no effect. It will affect my non-current assets. We can now get our total now. Our total. Please let's sum. Our
The
total
non-current, we have 800.
non-current liability.
Ability, we have
I can
800.
take that myself, don't worry. Give me
Okay.
the first
Then
page.
the non-current asset, we have 1,510.
Okay. The figure here.
For the current asset, we have 338.6.
338.6. Next. How does to calculate to?
623.6.
We have 623.6.
623.6.
And 138.5.
Thank you. 138.6, Abby.
0.6.
It should be 6.
It's 0.6. It's 0.6.
This is 0.4 now.
Yes.
So this is our adjusted figure now. Adjusted. You can now go back to our statement now. We are going to pick all this figure back to that first page. I'll come here. Proposal 2. My non-current asset is now 1510.00. My current asset is now 338.60. I can sum the two to get my total asset. Please sum. My current liability is not affected. I'll pick that figure like that. My non-current liability is now 800 million. So please sum. Total here becomes.
Total asset, we have 1848.6.
Thank you. 1848.6. We have gotten total liability. Share capital, will this be affected?
No.
Will we maintain 240 million? Earnings per share, what is the new earnings per share?
3.6.
6 to 3.6. Total equity, please sum what do you have? 8.
We have 863.6.
0.6. Therefore, our total liability plus total equity, our total liability was 985. Please sum 184.86. Is that not, please?
It is.
Okay, we close that. Profit after tax now, after adjustments, 138.6. Is that not?
It is. 138.6.
138.6. Number of ordinary shares, it still remains 600 million.
Yes.
Now calculate
Unchanged.
earnings per share for me. What do you have, please? What is the earnings per share?
23.1.
23.1 kobo.
Yes.
23.1 kobo. The financial gearing, total liability divided by total assets. $53.3% with proposal 2. Earnings per share will increase very well. Financial risk will also increase, but it's still better than proposal 1. Is that not, please?
Yes.
Proposal 3. I only have like 15 minutes, so. Okay, but once you understand it, we can always deal with it.
Yes.
Proposal 3. Let's go to proposal 3. Let's look at it. The question says, proposal 3, to sell excess non-current asset in another hotel. The net book value of the asset is 100 million. They will be sold for 135 million. That means that the assets are sold at a premium. There's at a profit. There's profit on disposal. This will enable the company to focus on other high-performing hotels. That's not my problem. All the funds raised from the sale of the assets will be used to reduce the company's debt. Let's go to proposal 3 analysis now.
Sorry, I have a question.
Whiteboard.
Please, how did you get that 15 in proposal 2?
Okay, let's quickly show it, no problem. Look at it here, proposal 2, 15.
Yes, this return, 15. This return, okay, 15.
Tax return on investment, 15% on 100 million.
Was it telling the question?
It's there now, it's there.
So it's still telling the question. Okay.
Yes, please, look at it. Look at the last paragraph. The company's estimated after-tax return, rate of return on investment is expected to be 15% on any new investment. Full stop. It is expected that any reduction in investment will suffer the same rate of return. So when you invest in additional non-current asset, 100 million naira, we are going to generate 15% return on that investment. When you reduce your investments, then your return will also reduce by 15%. Is that clear, man?
Yes, sir.
Right. Proposal 3 now. Proposal 3. Sell excess non-current assets The book value is the book value of this asset, book value of the assets, is equal to 100 million. Amount realized on sales, is 135 million. All the money, all the funds realized will be used to reduce the company's debt. So what is the impact of this now? That means the company's debt will reduce by 135 million. Is that not? Hello? Hello?
Yes, sir.
Now, if the company's debt reduces by 135 million, what happened to our interest expense?
It
It's
reduces.
Thank you. That is what we call interest saved. I'll come here. Gross interest saved. That is, by repaying this 135 million, we are not going to pay interest again on this 135 million. It means the interest will be saved. 6% of 135 million. This interest will not be paid again. Please compute. Interest payable on the debt is 6%. We are now reducing the debt. That means we are repaying the debt by 135 million. It means that on this 135 million, we are not paying interest again. What is the
8.1.
interest saved?
8.1.
8.1 million. Okay. Thank you. 8.1 million. Okay. Now, extra interest saved on existing, on remaining loan, on remaining, no, that's not the right spelling. Remaining debt. What is the remaining debt, please? Let me deal with that first. Out of 700 million, we have repaid 135. We are left with what? 700 million is the existing debt. We now repay 135 million. We are left with what?
565.
We are left with 565. Okay. Now let's go back to the question. What is the term of the loan contract? Look at this paragraph, please. The terms of the loan contract stipulates that any increase in borrowing will result in increase in the coupon payable of 25 basis points on the total amount borrowed, while a reduction in borrowing, now, We have done reduction in borrowing. We lower the coupon payable by 15 basis points. That means on this remaining loan, remaining debt, we are still going to enjoy reduction in interest. We are not supposed to pay 6%. We are supposed to pay 6% minus 15 basis points. Now, we have paid 6% before. We are not going to take away 15 basis points. 15 basis points converted to percentage, 15 divided by 100. That will now give me, look at it, 0.15%. On the remaining debt, we are going to save 0.15% interest. Is that clear, please?
Clear,
Yes,
sir.
sir.
Yeah. So please compute 0.15% of 565 million. What do you have?
84.75.
That's wrong, sir. That's 0.15. You are going to divide it by 100 first. It's
Okay.
percentage now. That should give you 0 point something.
0.8475.
Yeah. That will give us 0.8475. You can now add the two interest saved. 8.1 plus 0.8475. Total interest saved. Total interest saved. Total how much? 8 point what? I think 8.9475. You are going to add 8.1 plus 0.8475. This is the total interest saved. That means your profit will increase by this amount. It means your profit will increase by this amount. If your profit increases, what happens to your tax?
It increases.
Thank you. Now come here. Tax effects. Tax effects. Tax effect 20%. Please compute 20% of 8.9457. Oh yeah. That will give me 1.7.
1.7894.
9. I got 95 here.
Okay.
95.
Yes,
You can now
95.
deduct this. Deduct this minus 8.9. You are going to have 7.158. This is called interest saved net of tax. Interest saved net of tax. Your profit will increase by this amount. This will affect your profits. By saving interest, profit will increase. Retained earnings will increase. By saving your interest, you have more revenue, you have more cash. That means you are conserving your cash. You are not paying the cash out again. Current asset will be affected. We are still not done. You continue. Let me just finish this question. Okay. I will expand this more. What are we doing with the money realized from the sale of the assets? Hello?
We use it to
reducing our
reduce debt.
We are going to use it to, okay, we haven't done with that. We are selling our non-current assets. Okay, look at it. That is, by selling your non-current assets, that is reduction of investment. You are disposing your hotel out. The hotel that worth 100 million, you are going to dispose it. That means there's a reduction on investment. Look at it. I'll come here. Reduction in investments by 100 million. An investment that was 100 million is being disposed of. Now, what is the rule? Where there's reduction in investments, let's go back to the question. Please look at the last paragraph again. The company estimated after-tax rate of return on is expected to be 15% on any new investment. It is expected that any reduction in investment will suffer the same rate of return. That means by reducing our investment by 100 million, our return will also reduce by 100 million. Look at it, please. I will now come here. Our return will reduce by 15%. We can now come here and do like this. Look at it. Return loss. 15% of 100 million. That will give me 15 million. That means that our return will reduce by 15 million. Loss of return will affect our profits, we affect our retained earnings, we affect our current asset. By reducing the investments, we are going to lose revenue, returns. Your revenue can either be in form of cash or trade receivables. Hence, if your revenue is in form of cash, it will affect your current assets. If your revenue is in form of trade receivables, then it will also affect your current assets. Then lastly, before we look at the effects, we have profit on disposal. Profits on disposal. This is equal to 135 million. Amount realized from the assets minus the book value of the assets. This is 135 million. That will give us 35 million profit. Of course, the profit on disposal, we have impacts on our profits. We have impact on our retained earnings, but will not affect our current assets. Why? Why? Because all the profit, all the money realized, the 135 million, everything was used to repay debt. So we have these three items. These three items, what will they affect? Our income statement, let's look at it. I'll just come here. The same way we did, we have our profit after tax, our retained earnings, our current assets. Let's take these three. Our current assets. Balance before the proposal. This is 130 million. This is 615. This is 330. Interest saved, net of tax. The amount is 7.158. This will affect my profit. This will increase my profit. This will increase my retained earnings. This will increase my cash because I'm not going to pay out cash again. My cash will increase. Next, return loss. This will return loss. This is 15 million. This will reduce my profits. This will reduce my retained earnings. This will reduce my cash. Next, Profit on disposal. Profit on disposal. This will increase my profits. This will increase my retained earnings. This will not affect my current asset because all the cash has been used to repay debt. Please, let's get the figure out here. Total.
$142.8 for the first one.
Are you sure?
Yes.
Where's my cost reserve? The first one, somebody said 142.8.
Yeah.
Please reconfirm that.
It's 157.158.
Thank you. This is 157.158. Next.
$642.5.
642.158. Next.
322.158.
322.158. Let's go round up on the first board, the first whiteboard. Let's go round up. My PM today, I hope it won't suffer. Where's my first one? You can come here now. Proposal 3. Or this should be 3. Proposal 3. No time to waste time here. Of course, we are going to sell our non-current asset that worth 100 million. That means this non-current asset will reduce by 100 million. 1410 minus 100 million. That will give me
1310.
1310. My current asset now has computed 322.158. 322.158. Total, please.
1632. 1632.158.
632.158. 58. Just 1 minute. I'll be finished on 2 minutes. Okay. I think we got 133. Please check this again. I don't want to come back to this thing. Is this figure correct? Is this figure correct? 322.158.
It's correct.
Okay, that means maybe I'm the one making mistake. Okay, let's go on. Whatever the case. Our current liability is not affected. 185 still remain. Our current liability, non-current liability, our debt will reduce by 135 million. We are left with 565. Total liability, please sum. 185 plus 565.
750.
750, thank you. I'll close this. Share capital remain unchanged. Retained earnings. $642.158. 642.158. Total equity, please sum up.
882.158.
882.158. This should be 8, not 6. Therefore, liability and total capital,
1632.158.
This must balance.
Yes, sir.
You can close this now. Our need 57.158. Number of ordinary shares remain unchanged because nothing is affecting this. 600 million. Now calculate earnings per share.
26.2.
26. No, this is wrong. 26.2 kobo. Once you multiply by 100, that means you have your answer in kobo. Then calculate the financial gearing. Liability divided by total assets. 750 divided by 163.2. 158.
50%.
Multiplied by 100.
50%.
What do you have?
46%, yes. Or it is
45.95%. All right, we are done with the question now.
Okay, we cannot approximate it.
No, you can. But if you are doing that, you have to do for everything.
Okay.
We are done with the question. You can now respond to this. What is the impact of proposal 1 on the earnings? Earnings per share will increase slightly. Risk will increase high, very high. Proposal 2, earnings per share will also increase. Risk will increase, but it's still reasonable.
Yes.
Proposal 3, earnings per share will increase. Financial gearing will reduce.
Will reduce.
If you look at proposal 3 appears to be the best option.
Yes.
Proposal 3 appears to be the best option for the company. However, the increase in profit was as a result of asset disposal. Asset disposal is a one-off transaction. The company may not be able to sustain the increase in profits at future periods. You are going to explain that to the examiner. That proposal 3 appears to be the best option. However, the increase in profits is as a result of asset disposal. Asset disposal is a one-off transaction, a one-off. That's why we call it extraordinary items. It is not every year company will be disposing assets. It's a one-off transaction. That increase in profit is not coming from operation. It's as a result of, it's not as a result of operational efficiency. It's as a result of asset disposal. So the company should be aware that if proposal 3 is pursued, you may get increase in profit this year, but increase in profits may not be sustained at further years. If you are selling your non-current assets, that means you are reducing the ability of the company to make more profits. All right, thank you.
Thank
Any
you, sir.
questions?
Sir, please, will you share this material with us?
Definitely now. The solution will be shared with the class as soon as we are done.
Hello, sir.
Hello, sir. I
Be
have a
ready when
question.
the person in charge. Okay, go ahead with your question.
Okay, sir.
On the disposal of assets, the profit on disposal. Hello, sir. Can you hear me?
I can hear you clearly.
Okay. We
What
did not
about
add
the
the
tax?
15. We did not add the 15 to the profit on disposal. Why is there a reason? Because if you are selling an asset, you are definitely receiving cash. So why is it not affecting the current assets? On the
Okay,
third
I
proposal.
explained that. I explained that before. When we dispose the asset, we got the cash.
We're using it to settle liability.
We now use the old cash we received to repay debt.
Yes.
Is that clear, sir?
Okay, sir. Okay.
That's why we are not adding that money to our current asset. It has been used to repay our cash. All right. May God give us a better understanding. Our next class, we shall be looking at dividend policy. Let's have a blessed morning.
Thank
I'll
you,
be
sir.
checking out of the classroom.
Thank you, sir.